Hey everyone, and welcome to this explainer. Today, we're unpacking a massive transformation in the crypto industry. We're looking at how 2025 took crypto from a year of major record-breaking milestones straight into becoming the absolute bedrock for intelligent finance. We are literally watching the transition from what used to be a wild west of speculation into a deeply embedded, structurally sound pillar of the global financial system.
Okay, let's kick things off by just anchoring ourselves to the sheer, mind-boggling scale of 2025. It was a historic year where the global crypto market cap smashed right through the $4 trillion threshold for the very first time. And to put that into perspective, Bitcoin also hit a staggering all-time high of $126,000. So we're definitely no longer talking about some fringe internet experiment here. We are talking about an asset class that now sits shoulder to shoulder with the absolute largest public companies in the world.
To make sense of this massive shift, we're going to follow a quick 5-point agenda. First, 2025, crypto's mainstream milestone. Second, Bitcoin's institutional era. Third, DeFi's structural institutionalization. Fourth, stablecoins, the settlement layer. And finally, we'll look ahead at the 2026 frontier, AI and DeFi.
Let's dive right into Section 1, 2025, crypto's mainstream milestone, and navigating a $4 trillion market.
Now, despite all those record highs we just talked about, 2025 was actually incredibly turbulent. We saw a dramatic 76% intra-year trading range. The total market cap was literally oscillating, dropping to a low of $2.39 trillion in April, and then swinging all the way up to a peak near $4.22 trillion by October. That is enough whiplash to make even the most seasoned trader dizzy. It was basically a classic tug of war. On one side, you had these massive tailwinds, like new stablecoin legislation and heavy institutional adoption. But pulling right back were escalating geopolitical tensions and sticky inflation, which created a really volatile environment for risk assets.
Moving past that macro volatility, we hit Section 2, Bitcoin's institutional era, focusing on corporate treasuries and Wall Street adoption.
You know, the sheer speed of traditional finance adopting Bitcoin has just been staggering. Look at this contrast. U.S. spot Bitcoin ETFs absorbed $53 billion in cumulative net inflows in just one single year. To reach that exact same milestone, it took gold ETFs roughly 5 whole years after they launched back in 2004. The institutional adoption story didn't just survive the year, it accelerated at a record-breaking pace, driven almost entirely by these regulated investment channels.
And it wasn't just Wall Street ETFs either. Corporate adoption absolutely exploded. We now have 194 publicly listed companies holding roughly 1.1 million Bitcoin right on their balance sheets. Think about that. That's about 5.5% of the total Bitcoin supply, worth around $100 billion. This completely blew past previous forecasts that didn't expect corporate holdings to cross that 1 million mark until 2026. Bitcoin is now for sure a mainstream corporate treasury asset.
Now, the 2024 halving presented a super fascinating contrast. The drop in miner awards was mathematically predictable, right? It dropped exactly from 6.25 to 3.125 BTC. But the market reality? Anything but predictable. Bitcoin's price surged past $109,000 post-halving. This gave some temporary relief for miners who were facing serious margin compression, but it also completely reshaped the mining landscape. We saw a very clear separation happen. Well-capitalized miners with highly efficient equipment pulled way ahead, proving that the mining industry is professionalizing incredibly fast.
Which brings us right into Section 3, DeFi's structural institutionalization, focusing on capital efficiency and compliance.
Listen, if you take away just one single concept from this entire explainer, please let it be structural institutionalization. This was the defining shift of 2025. It basically means DeFi finally grew up. It transitioned away from being a wild casino driven by high inflation token incentives and turned into this hardened, compliant, capital-efficient powerhouse. It's no longer just some parallel sandbox system. It's generating real economic value that's fully entangled with the global macroeconomy. And the data backs this up perfectly. Total value locked stabilized at an impressive $124.4 billion. But honestly, the composition of that capital is what really matters here. We witnessed a historic flippening where the total value locked in real-world assets, or RWAs, hit $17 billion, officially surpassing decentralized exchanges. This was heavily driven by tokenized treasuries and private credit bringing real-world cash flows on-chain. On top of that, DeFi protocols generated $16.2 billion in revenue, practically rivaling major traditional finance institutions. Governance tokens basically had their big blue chip moment.
Powering all of this institutional momentum brings us to Section 4, stablecoins, the settlement layer, and what many are calling the new internet fiat. In what was undeniably their greatest year on record, stablecoins absolutely shattered expectations. They surged past a $307.5 billion market capitalization. In just over a decade of existing, stablecoin adoption went entirely mainstream. They've become the new dominant settlement layer, with transaction volumes that are literally rivaling traditional giants like Visa right now.
But notice the internal shift within that massive market. While Tether and Circle still completely dominate, the balance of power actually shifted. We saw USDC gain serious ground against USDT. Why did this happen? Well, following the passage of the U.S. Genius Act, there was a structural rebalancing. Institutions executed this massive flight to quality, prioritizing USDC as a settlement layer for their regulated ETFs and tokenized treasury vehicles, specifically because of its strict regulatory alignment.
But hey, this wasn't just a US phenomenon. Over in Europe, the implementation of the rigorous MiCA licensing framework drove incredible growth. It doubled the euro stablecoin market cap to roughly $685 million. And get this, transaction volumes in those regulated environments surged ninefold. What this clearly tells us is that moving forward, stablecoin growth is going to be driven by compliance, audits, and regulatory interoperability, not just raw, unregulated liquidity.
So looking ahead to the frontier, we arrive at Section 5, the 2026 frontier, AI and DPI, and the machine economy.
With institutions now deeply embedded in the system and retail interfaces feeling super refined, it begs a fascinating, almost sci-fi question. Who or what is the primary crypto customer of tomorrow?
The answer, increasingly, isn't actually human. It's autonomous AI agents and decentralized physical AI, or DePi. We are entering an era where AI agents are utilizing blockchain as their native financial rails so they can coordinate, transact, and manage real-world infrastructure entirely on their own.
We're already seeing agentic commerce scaling up via HTTP native settlement. That's essentially allowing machines to seamlessly pay each other per call for APIs and data. But to do this at a massive scale, AI agents require capabilities that human operators just don't possess. They demand sub-second, low-latency networks capable of millisecond settlement speeds. Because of this huge infrastructure demand, it's actually predicted that within a few short years, decentralized exchange trading volume contributed by AI agents will exceed the volume of human traders.
As we wrap up this explainer on the great formalization, I want to leave you with this final thought to chew on. When autonomous machines need to settle transactions in milliseconds across global borders, is the legacy traditional finance system actually equipped to handle that? Or have the hardened, compliant blockchain rails of 2025 just become the undeniable default for the future of intelligent finance? It's a profound shift and one that's definitely going to define the years to come. Thanks so much for joining me, and keep exploring.